Good afternoon, everybody. Welcome to today's informative session. Um, we're very lucky to teaming up with uh, our partners at the Retirement and Pension Fund. I would like to thank Jeanette Carmona and her team who always support us. And of course, today's presenters, Dale Mason and Jose Sobrado, who will be introduced later. Uh, I just want to again welcome everyone, welcome my colleagues from the staff committee, and of course, our colleagues from both headquarters and national offices. Um, this is one more activity that we're doing based on the belief that knowledge is power, and by sharing accurate information with the staff, we're empowering everybody. Um, I think we all envision retirement and we think, oh, well, I'll just get to that age and then my money will come in and I'll spend everything I've saved. And the surprises come often too late for many people who don't have this accurate information handy when there's still time to plan and to change things and arrange a more convenient scenario for our retirement. So we're very fortunate to have this team supporting us today. And I would like to encourage everyone to just, if you are anywhere near retirement age, to approach Jeanette in a timely manner to get some information. And so we're just trying to empower people by putting useful, accurate information in front of you. So with that said, I would like to hand it over to Marty Wanicki, who is our staff representative at represents the participants in the Retirement and Pension Fund. Marty?
Thank you, Jaime. Good afternoon, everyone. Welcome to today's session. Thank you for taking time to attend it, and especially considering today's weather. We know it have a few more complications than we had anticipated. I just wanted, before we get started, to share a couple of procedural instructions. As was noted in the invitation, there will be an opportunity for participants to ask questions of the presenters via the chat function of the Zoom platform. And we do ask that your questions only be submitted via the chat function and not verbally, just for matters of time management. And the presenters will be monitoring the chat and will respond to as many questions as possible, time permitting, once they finish with their presentation, which should be around, I think, around 45 minutes. So please do feel free to post your questions during the presentation and also after, and they will be compiling those and choosing the questions to respond to. Today's session is also being recorded, and so both the recording of today's session as well as the PowerPoint presentation from the presenters will be made in case anyone and will be there for the unforeseen future. So anyone who wants to access it can do so if you're not able to attend, or if you want to just brush up on what the contents were. I also wanted to take this opportunity on behalf of the Staff Association to thank the Inter-American Commission of Women for allowing us to use their Zoom platform, which allows for greater participation, a number of participants. So thanks to them for this for that important collaboration. We hope today's session is helpful and help. I mentioned in anticipation of retirement. There's a lot to cover today, so I'm not going to say anything more at this point, but just would like to give the floor to Jeanette Carmona, the Secretary Treasurer of the OAS Retirement and Pension Fund, to say a few words about today's presentation and introduce today's presenters.
Fantastic. Thank you, Marty. Good afternoon, everyone. Thank you all for joining us today. We're pleased to jointly host this seminar, which will address areas that is often complex and confusing for many of our staff members as it relates to the tax treatment of income and pension benefits of G-4 visa holders. These issues related to taxation are important matters in your career, especially when you're planning for retirement, separation from service, or potentially transitioning from a G-4 status to a permanent residency in the United States. Today, we are fortunate to have two experienced professionals who are specialized in these matters. We have Dale Mason. Dale is a CPA with over 25 years of experience in international tax consultancy. He has been highly sought after as a speaker and a trusted tax advisor to employees, retirees, and families from the World Bank, the International Monetary Fund, the International American Development Bank, and the United Nations. We also have Jose Sobrado. He is with the MG Capital Partners. He is a licensed financial planner with expertise in working with cross-border and global clients. So without further ado, it is my pleasure to introduce Dale Mason and Jose Sobrado. Thank you both for taking the time to share your expertise with us today.
Thanks very much, Jeanette. Hello, everybody. It's good to be here at the OAS, and today we get to have exciting tax information presented to you folks who are G4 visa holders. Next slide, please. The first thing I have to do is say a disclaimer, not because necessarily I'm going to say anything incorrectly, but because the US tax system is the most complicated tax system in the entire world, bar none. And when you add into that G4 visa holder taxation, it even gets even more complicated. So today we might be able to get over across to you folks the general rule, but usually there's an exception to the general rule and an exception to the exception. So please seek professional tax, legal, and or financial assistance based on your own specific set of facts and circumstances. This is not individual tax advice today. Next slide, please. So we have a lot to cover. We're going to talk about G4 income tax residency and why you folks that are G4 visa holders are probably going to be non-resident for the most part. Then we're going to talk about the ownership of U.S. real property and the taxation of that to G4 visa holders, including rental property and what happens if you sell your principal residence that you've been living in for many years now. What is the tax?
Yes, Mama.
That? Finally, we're going to talk about FIRPTA tax withholding, which is the Foreign Investment in Real Property Tax Act that may apply to you non-residents who sell any type of U.S. real property. That would include a rental property, your home, or any land that you may own in the United States. You're going to be subject to this withholding tax. And finally, Jose is going to talk about the taxation of investment income to G4 visa holders and give some retirement planning tips based on the OAS retirement. So stay tuned for these things. Next slide, please. So tax residency. Why does tax residency matter? Well, U.S. citizens, green card holders, and persons who make the so-called 6013G election and people who meet the substantial presence test of tax residency are U.S. tax residents and subject to tax not on certain U.S. sources of income, but instead taxed based on your worldwide income. No matter where you derive that income, you become subject to it if you become a U.S. tax resident. Now, non-residents, for the most part, G4 visa holders, are going to be subject to only limited sources of U.S. source income that will be subject to taxation. And we'll go over some of those sources of taxation today. Next slide, please. So, did you know that in the Internal Revenue Code, they don't mention G4 visa holders at all? Instead, what they do say is that the days of presence in the U.S. are not counted for purposes of the substantial presence test of tax residency if the individual is a full-time employee of an international organization such as the OAS. So in order for your days not to count, and therefore it's like you're not even here, and that's why you're a non-resident for the most part, you have to have a full-time employment contract with the OAS in order for your days not to count and in order for you to be a non-resident of the US. So most G4 visa holders in the United States are considered non-residents, and that would include a G4 dependent visa holder, that's the spouse of the primary G4 visa holder, and unmarried I should say, the G4 dependent spouse and unmarried G4 dependent children under the age of 21 are also going to be considered non-residents of the United States. So if your child is on a G4 visa, but they've just turned 21 and they're going to university, as soon as they turn 21, their days of presence start counting for purposes of the substantial presence test of tax residency, and then therefore they could become a U.S. tax resident in the United States, even though they're a G4 visa holder. It should be noted that G4 dependent spouses are always going to be considered non-residents of the United States, even if they work for a private company, a non-international organization employer in the United States, or are self-employed. This is important to note that G4 dependent visa holders are going to be considered non-residents because the tax return that they may have to file is always going to be a 1040 non-resident tax return, a 1040 NR. So if you're a G4 dependent or your spouse is a G4 dependent, note that they should not file the residency tax form called the Form 1040. They have to file the 1040 non-resident tax return, 1040 NR. Next slide, please. Now, when do you become a U.S. tax resident? Well, there are two primary tests. There's the green card test, and that's an easy test to see when you become a tax resident. And that would be U.S. tax residency begins on the first day that you're in the United States with a valid green card. So if it should be that you're outside the US and you're issued the green card, your first day of presence in the United States is when that your first day of tax residency starts counting. Now, under the substantial presence test of tax residency, and many people that retire from the OES and are eligible to stay in the United States waiting for their green card, if that's you, then the day that you retired, because you're no longer a full-time employee of an international organization, you're simply in the United States without getting this protection of your days not counting. Your days do start counting on the first day of retirement. And if you meet the substantial presence test as shown here, then you can become a tax resident. And you become a tax resident the earlier of the substantial presence test or the green card test. Next slide, please. Now, there's another way to become a U.S. tax resident, but it's only if you're a primary G4 visa holder married to a U.S. person. Usually, this is going to be a U.S. citizen or a green card holder. So, if you're a G4 visa holder married to a U.S. person, you can make this so-called 6013G election to treat the G4 non-resident spouse as a U.S. tax resident. So why is this important? Because if you are eligible, if you are a G4 visa holder married to a U.S. person, that means that you can file a joint income tax return if you make this election to be treated as a U.S. tax resident. Now, the good news for you folks, if you make this election, is that even though you have made the election to be a U.S. tax resident married to a U.S. person, your OAS compensation income would not be subject to tax. It would still be tax exempt. So you can file a joint tax return with your U.S. person spouse, and your U.S. person spouse will report your name on the jointly filed U.S. income tax return, but not have to include your wages from the OAS. That therefore the spouse, the U.S. person spouse, typically their tax rate, because they would be filing joint tax returns, would fall dramatically. And therefore, it's important to note that this election can be very beneficial to some people who are married to U.S. persons. Now, the good news about this election is you only have to file the election one time, and it's valid indefinitely into the future, but you can only revoke it one time. So you can make the election one time to be a U.S. person to file jointly with your spouse, and you can revoke it one time. So you can't just go back and forth between married filing separate and being a non-resident and married filing joint being a resident. You make it one time and then you file a married filing joint tax return indefinitely into the future. Next slide, please. So the general tips, if you do have a tax filing requirement, the 1040 non-resident tax return for a G-4 primary visa holder who has income to report, let's say, not your compensation income, but other U.S. source income to report, it's generally due June 15th. But if you have wages, like for example, your G4 dependent spouse, if they have wages subject to income tax withholding, which they would if they were working for a private company, then their tax due date is April 15th. And state income tax returns are generally due April 15th. So to make matters easy, so you always remember to file your tax returns, if you do have a tax filing requirement, you do have some U.S. source income subject to tax, then you should file your tax returns on or before April 15th. It just makes everything so much easier if you did that. Um, and one point that should be noted is that most people who are coming from a foreign country into the U.S. to take up employment with the OAS will lose tax residency in their home country. And because they're now a G4 non-resident in the U.S., they're non-residents of the U.S. everywhere in the world. So that means that if you're non-residents everywhere in the world, you have to file a 1040 non-resident tax return. And generally, dependents, the children that you have that are maybe U.S. citizens even, they cannot be claimed as dependents typically on the 1040 non-resident tax return, even though there are line items for dependents. And the reason for that is the U.S. tax system, like I said before, is complicated and it doesn't make a lot of common sense. But the only people that are non-residents that can take to put dependents on their non-resident tax return are people who are tax resident in Mexico, Canada, and South Korea. But as I was mentioning, most people who come to the US lose their tax residency in their home country. So most likely you're not going to be a tax resident in Mexico, Canada, or South Korea. So that's why you're unable to claim a dependent on your non-resident tax returns. And also note that pretty much only state taxes and charitable contributions are allowed as itemized deductions on your non-resident tax return. There is no such thing as a standard deduction which only resident person that files a 1040 can take advantage of, but not non-residents. Next slide, please. So let's talk about the taxation of rental income. If you have a U.S. rental property, or even if you rent out your basement, you have to file that income and associated expenses on the 1040 non-resident tax return. There is no de minimis amount that you can have as gross rental income so that you won't have to file your tax return. You always have to file your tax return if you have any type of U.S. gross income from a U.S. rental property. Now, the interesting thing to note on owning a U.S. rental property as a non-resident are a couple of things. The first one is that, generally speaking, if you don't make the so-called net election on the first tax return that you have a U.S. rental property, then the IRS can charge you a 30% flat tax rate on the gross rents that you receive from that property. Now, as far as I know, nobody will ever want to have 30% flat tax rates and not getting any tax deductions associated with that rental income. So most of my clients will, and I would advise almost every client to take advantage of the deductions available to you when having rental income by making the so-called net election. Now, this net election is simply a white piece of paper that's attached to your first tax return that you have a rental, and you are able to deduct all ordinary and necessary expenses related to that U.S. rental property. That would include mortgage interest, property taxes, repairs, maintenance, and any other expenses that you incur so that you are able to generate that rental income. So in addition to that, you're eligible for a depreciation deduction. And for residential real estate, you're able to deduct the building portion of your property over a 27.5 year period. See what I mean by kind of crazy US complexity? 27.5 years. So that means if the building portion of your rental property was $275,000 divided by 27.5 year useful life on the building portion only, that would be $10,000 a year that you're able to deduct from your gross rental income as a depreciation deduction. And so not only should you make this net election so you get to deduct all the ordinary and necessary expenses, but then you'll also be eligible to deduct depreciation. Next slide, please. Now, the good news for US citizens, green card holders, and G-4 visa holders is the sale of a principal residence. So every individual in the United States can exclude up to $250,000 or $500,000 if you own that principal residence jointly. You can exclude $250,000 if you're single, or $500,000 on the jointly owned property. This is the gain that you can exclude from the sale of the principal residence, not the gross amount of sales price, but the actual gain up to $500,000 can be excluded. The only real rule there is for this is that you must own the principal residence as a principal residence and occupy it as an owner for at least 2 years out of the previous 5 years prior to the sale. So as long as you owned it and lived in it at least 2 years out of the previous 5 years before the sale, you're eligible for this $250,000 or $500,000 exclusion. So you just look at the sales date, count back 5 years, and as long as you've lived in it at least 2 of those previous 5 years, you're eligible to get the $250,000 or $500,000 capital gain exclusion. Next slide, please. Now, because the US government doesn't necessarily trust non-residents, because most non-residents are living outside of the United States, they impose what's called the Foreign Investment and Real Property Tax Act tax withholding, FIRPTA for short, FIRPTA. And all non-residents, including G-4 non-residents, will be subject to this FIRPTA withholding. It requires the U.S. withholding agent to withhold either a 10% amount or 15% amount of the gross sales price of the U.S. real property sold by the non-resident. Now, this is a withholding tax, not a final tax liability. As I mentioned before, most people that are selling their U.S. principal residence are not going to have to pay tax because of the principal residence exclusion. But you will have to you will have to pay this 10% or 15% withholding tax first, and then it's your job to get the money back as a refund. Next slide, please. Now, there's a couple of ways of getting the FIRPTA withholding refund back. The first way, especially if you sold the property early on in the year, is through what's called a certificate of withholding. It's a 8288B. This eliminates or reduces the withholding. Now, we don't have time to get into it, but if you Google 8288B, you'll see what I'm talking about. The next possible way of getting your refund from the FIRPTA withholding is simply to file a 1040 non-resident tax return after the end of the year that you've sold your property. So if you sold your property, let's say in September of 2025, you would simply file a 1040 NR for 2025 and claim the refund, the FIRPTA refund back. Next slide, please. And now we'll go over to Jose, who will talk about investment income.
Thank you, Dale. That was great. Thank you again to our sponsors for this opportunity, and welcome everybody. We appreciate everybody being here despite the terrible weather. Please stay safe out there. We are very much looking forward to your questions. Just as a reminder, please take time to type your questions as we go along. Dale and I love answering questions, and that's really the best way to make this presentation as valuable to as it can be for many of you. So you've heard Dale talk about general concepts of tax residency and tax returns, talk about taxation of your wages, as well as rental income and capital gains from the sale of your property. Today, we also want to talk about investment income and, of course, your retirement benefits. So let me move on and start with investment income. By the way, when it comes to your questions, we prefer that you write them in English, and we will answer them in English. But if it helps you to write them in Spanish, please go ahead. We can certainly translate them. On investment income, as Dale said, of course, you are all non-residents as G-4 visa holders, and you are taxed as non-residents. In other words, only certain types of earnings from your investments will be considered U.S. source and taxable to you as a non-resident. We are going to talk specifically about different types of earnings and how they are taxed, but in general, the tax rate that applies to investment income that is taxable in the US to non-residents is 30%. That is the standard flat tax rate applicable to non-residents on taxable investment income. You may be aware of tax treaties and perhaps the fact that people that are covered under tax treaties may be eligible for lower tax rates than that 30%. But unfortunately, most of you are not covered by tax treaties. If you live here permanently and you're not spending significant days in another country, you're probably not a tax resident anywhere else, and you're also not a tax resident here. So you're not a tax resident anywhere, and therefore there's no applicability of tax treaties, and 30% is the rate that you will pay on taxable investment income here in the U.S. And there are no deductions, as Dale discussed. There's no deductions available, nothing like a standard deduction, nothing like a de minimis. Every dollar of earning from your investments that is subject to taxes must be paid, must be taxed and paid, and the liability paid. So many of you are probably aware of the form called the W-8BEN. Anytime you set up a financial account in the US, whether it's at your bank, your credit union, a brokerage institution, even insurance companies, any type of financial institution that you work with in the US must understand the fact that you're a non-resident. And the way to do so is for you to present this W-8BEN form to the financial institution that you're working with. That is the only way that they're going to understand that you're a non-resident, certify your non-resident status, and make sure that everything for you works properly as it should. There are sometimes complications with this process. If you're working with financial institutions that perhaps don't understand your particularities as a G-4 visa holder, it is common to have issues when it comes to certifying your non-resident status at many financial institutions in the US. For starters, many financial institutions here simply don't work with non-residents. So if you approach them as somebody who lives and works here and has a social security number, they may initially think that they can do business with you, but upon you disclosing that you're a non-resident, they may simply not be able to do business with you based on their policies. That's often the case, but not always. There are many financial institutions that do work with non-residents, and they will be able to accept a W-8BN, but your W-8BN is going to be different than most others. So it can create some difficulties for some financial institutions. To begin with, your address is here. Your legal place of residence is in the US, so your permanent residence address is here, which is very different from 99.9% of W-8BN submitted in the US. Most come along with a foreign address and somebody who doesn't have a social security. Your case is different, and that information must be part of your submission, so it will raise additional questions and require usually for you to explain your circumstances, your passport, your visa, proof of your address, proof of your employment are typically things that need to accompany your W-8BN for financial institutions to be able to accept you and certify you correctly. Another area of potential problems is the claim of treaty benefits. In the W-8BN, you can specify if you're a tax resident of another jurisdiction for purposes of tax withholding, but that's usually not going to be your case, so this section will be blank, and that often also raises questions from financial institutions. But don't be discouraged. Investing and planning ahead, saving and investing is very important for all of us, for your retirement, for many other reasons. So don't be discouraged and take advantage of the investment opportunities that you have, despite your non-resident status. In many cases, as we're going to discuss, your status can be a significant advantage. Let's talk about dividends to begin with. So if you own shares of corporations in the US or abroad, you may receive dividend income from those investments. Dividends are taxed in the US depending on the source. Remember, US source income is the type of income that can be taxed in the US to non-residents. So if your dividends originate from a US registered entity, a US corporation, those dividends are subject to taxes, the 30% that we talked about. Instead, if your dividends come from a foreign source, that could be investments that you have outside of the US, but it could also be investments that you have in the US, in a US-based financial institution. You may own shares of foreign companies, and you may receive dividends from those, typically in the form of ADRs. Now, those are foreign dividends, and those are not taxable here in the US. So a distinction in the origin makes a difference in how your dividends are taxed. The 30% tax rate on US dividends is quite high. If you have foreign dividends, you're not going to be taxed by the US. You could be taxed on the foreign jurisdiction, depending on where the corporation is registered, but it's usually going to be a much lower rate than 30%. Very importantly, when it comes to dividends, if your accounts are set up correctly, if you have a properly certified W-8BN at your financial institution, any taxes that you owe to the US on these dividends are going to be subject to withholding, right? The IRS doesn't necessarily trust that if you're a non-resident, that most of the time you're not even living here, they're not necessarily counting on you to file a tax return and pay those taxes. It is the responsibility of the financial institution that chooses to do business with a non-resident to withhold taxes. So that's why the W-8BN is important. That's also perhaps why many financial institutions here in the US don't do business with non-residents. It is their responsibility to withhold taxes and pay those on your behalf. It means that in most cases, there's no need for you as a G-4 visa holder, even if you have investments here in the US, to file US taxes. Ideally, those taxes are going to be withheld by the financial institution that you work with. Another important consideration when it comes to dividends is that is when you invest in US-based investment funds. The easiest way to invest your savings is probably through investment funds, ETFs, exchange-traded funds, or mutual funds. In that case, the principle of US source dividends is always going to apply. Any distribution that you receive from an investment fund, mutual fund, or ETF is going to be considered a US source dividend for tax purposes, and ideally subject to that 30% withholding. Now, this can be practical because it means you don't have to worry about filing taxes, but it can also be inefficient because, as you're going to learn, different types of dividends or other sources of income like interest, when they are not subject to taxes, will be subject to withholding if those investments are held inside of an ETF or a mutual fund. So investments in these types of investment funds is something to be very careful with. When it comes to investing as a G-4 visa holder, it may expose you to higher taxation than perhaps different types of structures. And that is relevant to how interests are taxed. So if you own a bank account or if you own a bond, a US Treasury bond, a US corporate bond, any type of fixed income security that pays you interest on a regular basis, as opposed to dividends, interest is never taxable to G-4 visa holders. You don't owe any taxes on interest that is paid directly to you through any of these types of investments. So this is a significant opportunity that you have when it comes to planning ahead and thinking for your future as a non-resident G4 visa holder. Because you're a non-resident here, interest is non-taxable, but also because you're a non-resident everywhere else, it's not taxable anywhere else either. So this is a good advantage to consider as a G4 visa holder. And like I said before, there could be some inefficiencies if you structure your investments inside of things like an ETF or a mutual fund, because when it comes to something like interest that would normally be non-taxable, it becomes taxable if those investments are held inside of these types of investment companies. And in addition to dividends and interest, capital gains are the third source of earnings that you can derive from an investment portfolio. And it's one that you should be very careful with as a G4 visa holder. So if you buy an investment today and then you later sell it in the future for a higher price than you paid for it, you realize a capital gain on that transaction. Generally speaking, the US does not tax capital gains of non-residents. So if you were an investor from anywhere else in the world, capital gains wouldn't be taxed to you. And that's a very attractive thing for non-residents to take advantage of. Now, unfortunately, there's a special rule that affects many G4 visa holders, which makes capital gains taxable. If the US is your tax home, which means you basically live here and work here on a permanent basis, in that case, and then if you also spend more than 183 days in the US, then you're still a non-resident because your days of presence don't count for the tax residency, but capital gains become taxable. Again, capital gains, which are normally non-taxable to non-residents, are usually taxable to G4 visa holders that are living and working in the US permanently, because most of you will probably spend more than 183 days here in the country. In that case, capital gains are taxed at the same flat rate that we discussed, 30% most of the time. And very importantly, because capital gains are generally non-taxable, they're also not subject to withholding. So it is probably the one reason why many G4 visa holders, in addition to perhaps rental income or capital gains from sale of your primary residence, it is the other big reason why you may have to file a tax return. If you have an investment portfolio and you have realized capital gains, there's never any withholding, even if your accounts are properly set up and properly certified. So this will require you to file a tax return and pay those taxes. It is something that many G4s often neglect, and it is important to keep in mind. It is important to keep in mind that the rule applies not just to investments that you hold in the US. If you have a brokerage account outside of the US and you trade on that brokerage account, stocks, bonds, mutual funds, anywhere in the world, if you trade on those investments and you realize capital gains, the rule applies in that case as well. Capital gains realized anywhere in the world are subject to US taxes based on this rule. Why? Well, because assets can be easily moved, right? So this rule really wouldn't make sense if people simply would be able to move their assets outside of the US. So it is based on a worldwide basis, and it affects realized gains from stocks, bonds, mutual funds, anywhere in the world. It is also it's only the net result from your trades, net gains minus losses. So it's very important to consider the possibility if you have to trade on your investments to offset gains with losses. That can be an important consideration for G4 visa holders. So let's move on to retirement. What happens on retirement? If you're a G4 visa holder and you simply leave the US after retirement, well, you were a non-resident the whole time and you will continue to be a resident after you leave. But if you stay in the US, your days of presence will begin to count. The moment you're no longer full-time employed by the OAS, in other words, your first day of retirement, that is your first day of presence for purposes of the substantial presence test. So your days begin to count based on the rules that Dale previously explained. And after you meet the rule based on the number of days, you will become a tax resident. What does that mean? It usually means that if you retire before July, you can accumulate enough days to be a tax resident in the same year that you retire. So in other words, if that happens, it means that all of your worldwide income, including your pension, is subject to taxes in the US for that year in which you retire, starting from the very first day that you retire. If you retire later in the year, of course, you may not be able to accumulate the necessary 183 days. So it's very possible that you remain a non-resident until January 1st. If you stay in the US continuously, then probably January 1st is likely to be your first day in which you become a tax resident after you have retired. Many retirees will become tax residents under the substantial presence test much before the green card test, right? Of course, eventually, when you receive the green card, you will also become a tax resident at that point. But most of you, especially nowadays, because of the time it takes to get the green card, it's the substantial presence test that matters. And from your first day of presence or January 1st, usually the following year, you are taxable. And it means, as you see here, that quarterly estimated tax payments are due. Dale talked about quarterly estimated payments. So prepayments of your tax liability before the April 15 filing deadline. That is required if you are going to be a tax resident from that very first day in which you are considered a tax resident. I'll come back to this slide in a minute, but the next slide is OAS pension plan defined benefit. So what about the benefits that you receive from your pension? If you are a non-resident, if you were a G4 your whole career and simply left the country after you retired, then your pension is non-taxable, whether it's the annuity that you're going to receive every month or whether it's a lump sum that you choose to take, it is non-taxable here in the US. It may very well be taxable somewhere else. We wouldn't know that necessarily, but here in the US, it's not going to be taxable. Now, your pension for US purposes is a US qualified pension plan. And that means that if you receive the pension as a tax resident, in other words, if you stay here and become a tax resident, either because of the substantial presence test or because you get your green card, then your pension is considered taxable. Not 100% of your pension is taxable. A part of your pension is taxable. A part of your pension is non-taxable. So you will pay taxes accordingly on the part that is taxable. You're also eligible for a lump sum. And if you do receive a lump sum as a tax resident, right, this is very important. You have to be a tax resident when you receive the lump sum. In that case, because the lump sum comes from a US qualified pension plan, it is also eligible to be rolled over to an individual retirement account. This can be very beneficial to many of you. The possibility of receiving a lump sum upfront can be very valuable for planning purposes. The possibility for a US tax resident to roll over or transfer that lump sum into an individual retirement account makes it even more attractive. So what does that mean? What does it mean to be able to roll over a pension distribution to an individual retirement account? It means that whatever part of your pension is non-taxable can go into a special retirement account that will make the future earnings also tax-free. If you receive $100,000 non-taxable from your pension plan, you can deposit that into an individual Roth IRA, and you can continue to invest that money for as long as you wish, and any future earnings that you accumulate from those investments will be tax-free. The part of your lump sum that you receive that is subject to taxes can also be rolled over to an individual retirement account, but it would be a different type of account. In that case, it would be a traditional IRA, which will mean that taxes are not due up front, but they are deferred. You will not have to pay taxes on an ongoing basis every year. You will only pay taxes in the future when you make distributions. So you get the benefit not of tax-free earnings, but of tax-deferred earnings. So all of that makes your lump sum very, very valuable. But it's important that you don't make the mistake of doing a rollover into an individual retirement account if you receive your pension as a non-resident. That can create potential tax problems down the road. So what if you change your status? What if you're currently a G4 and at some point while you're still working, you decide to obtain a green card? So the most immediate consequence of that is, of course, that part of that your wages become taxable. You're eligible for a tax reimbursement, so that's not necessarily a problem, but you have to comply with things like quarterly estimated taxes. No Social Security tax is due on the green card if you're a green card holder. So you will be taxable, you will get a reimbursement, and you won't have to pay for Social Security taxes. So until there, everything is fine with obtaining a green card, as long as you comply with things like quarterly estimated tax payments. However, another consequence of your wages being taxable is that more of your pension will be taxable. Remember, I said that if you receive your pension as a tax resident in the US, there's going to be a taxable component and a non-taxable component. If you were a G4 visa holder your entire career, probably about 60% of your pension would be taxable. If you were a green card holder your entire career, that percentage goes up. So more of your pension is taxable based on the fact that your wages were taxable. So that's something very important to consider if you're considering this transition. And eventually, many of you who transition to green card may choose to also obtain US citizenship. And that also means an additional change in the way your wages are taxed. The immediate consequence of that is that you will be liable for Social Security tax. You will owe 15.3% on average on Social Security tax, and the OAS will reimburse you for half of that. So you're going to be out of pocket for half of the Social Security tax due on your wages if you are a US citizen. Nothing else changes other than that, but it could, all things being equal, it means that your wages are worth less because of the Social Security tax, unless you can recover them. And the only way you can recover those Social Security taxes is by eventually qualifying for Social Security. That requires at least 10 years of contributions, but even then, Social Security is likely to be very, very small. So Social Security is calculated on the basis of 35 years of work history. So if you only have 10 years of contributions, you are going to have a lot of zeros, which make your Social Security very, very small. So these are just some of the things to consider when it comes to changing your status. There's a whole myriad of retirement planning aspects to consider as a G4 visa holder. I think we've covered quite a few today. We've talked about taxation of different types of investments, taxation of your lump sum, and of your pension. Probably it's important to think about other things as well, like what to do with the risk of long-term care. Long-term care planning is critical. It's something not typically addressed as part of your pension alone. Pension planning is not alone when it comes to retiring in the US. You also need to look at other things like longevity, mortality risk, and long-term care needs. These are all very important things to keep in mind. And probably when it comes to retiring, all of you should also consult with an estate attorney. Estate planning is very critical, especially for non-residents. The US does have taxes on inheritance. Usually they're not relevant for most people that are based permanently in the US, green card holder. US citizens are eligible for a very large exemption from any type of taxes on their inheritance. But if you're a non-resident, somebody who lived in the US, bought a home in the US, and then left and kept that home in the US, you may be subject to inheritance taxes as a non-resident. And in that case, there is not the same type of very large exemption available to people that are domiciled in the US. So in addition to income tax, retirement planning also requires thinking about these things. Insurance planning, long-term care, and estate planning are all very relevant to retirees, but unfortunately, maybe more than we have time for today. So with that, here's some information about us if you need to contact us, but we see quite a few questions and we are looking forward to answering them.
Yes, so the first question is, thank you, Jose. My wife is working for the district. Does she have to report taxes? Yes, as a G4 dependent. The answer to that is yes. So, as a G4 dependent, she would be a non-resident of the United States, and therefore she would be having to report U.S. source income. And working for the District of Columbia, or working in the District of Columbia, or working for the District of Columbia would be U.S. source income, and she would get a Form W-2 reporting her wages for the year, and therefore she would have a 1040 non-resident tax return filing requirement, as well as a District of Columbia tax return filing requirement. So it gets a little bit complicated when it comes to working in the district. I assume that you are actually a District of Columbia tax resident, and therefore you would just have to file a 1040 NR and a District of Columbia tax return. But if you are a resident of Virginia or Maryland, and you simply commute to work in the district doesn't have a non-resident tax duty to file. Instead, if you whatever tax jurisdiction where you are a resident in Virginia or Maryland and you commute to the district, if you are a tax resident of Virginia, then you file a Virginia tax return based on the work performed in the district. And if you're a Maryland tax resident, then you file a Maryland tax return based on the work you perform in the district. But definitely, she must file both a federal return and a state income tax return.
The next question is about joint accounts, joint investment accounts held jointly with a U.S. citizen spouse. So if you're a G4 visa holder, married to a U.S. citizen, and it's perfectly okay to have a joint investment account. Now, taxation may depend on, first and foremost, whether you are making the 6013G election. If you're filing jointly with your spouse, then the account is owned 50/50 by both of you, but included as one in your joint tax return. Ideally, the U.S. citizen should be the primary account holder so that there's no withholding and the financial institution will issue the normal 1099 forms. And then simply you go through the normal process of filing for investment income on a U.S. tax return. It may get a little bit more complicated if you're not filing jointly. If you're filing separately, your U.S. spouse is a U.S. person and you as a G4 dependent, then the account is still owned 50/50. Each one of you must report 50% of the account earnings in your separate tax return. And the account will be either subject to non-resident withholding or not, depending on who is the primary. And depending on who the primary account holder is, you'll either receive 1099 forms or the tax forms available to non-residents, which are slightly different. And so one of you will have a more difficult time completing your tax return. But it's perfectly okay. You may need some help, perhaps from a tax preparer to complete your tax returns, but it's perfectly okay to have a joint investment account. If you're filing separately, if you're a non-resident, the W-8BN is still required. Regardless of who is the primary account holder, you should have a W-8BN on file if you're the non-resident account holder.
The next question is, if a G4 visa holder receives a gift or inheritance in their home country, is there an obligation to report it to the IRS? The short answer is there's no obligation and there's no tax. So typically in the United States, the person who's either giving the gift or has passed away and leaves an estate to their heirs, the estate is the one that's subject to the inheritance tax or the estate tax, I should say. So if you're a person who's receiving a gift or an inheritance, then there is no tax to you and there is no reporting, especially if you're a G4 visa holder, a non-resident of the US.
So Dale, this person is a G4 visa holder who married a US citizen and received a green card, having to file taxes for the first time. They're asking about what documents to gather, steps to follow, and what is the tax reimbursement process from the IRS.
Okay, so important to note that only two full-year tax residents can file a joint income tax return. And if you received your green card in February 2025 after having a G-4 visa, you were non-resident for January, and then once you received your green card in February 2025, you became a resident and continued on residency, of course, until December 31st, and then in the future year, you'll be a full year tax resident. But in this first year, you're called a dual status taxpayer, a person who is a non-resident in the first portion of the year and a tax resident in the next portion of the year. And so in theory, you cannot file a joint income tax return with your US citizen spouse. However, there is an election. It's called a 6013H election, 6013H election. You can Google it, where you can back up your date of residency from February, the time that you got your green card, all the way to January, back to January 1st, so that you can become a full year tax resident. So you can file a joint income tax return with your U.S. citizen spouse. So look up that. But now there could be downsides because if you back it up and you were already subject to worldwide taxation, or I should say, then you'll be subject to worldwide taxation even in the month of January. And if you had a foreign rental property, for example, you'd have to include the January rental income on your U.S. income tax return. So there's some pros and cons of making the 6013H election, but generally speaking, you can do that and then file a joint income tax return with your U.S. citizen spouse. When it comes, I see here you're asking about the tax reimbursement. Yes. So if you become a green card holder in February 2025, you'll be entitled to a tax reimbursement from the OAS, but you'll of course have to contact the OAS to see what the process and procedures are to obtain that reimbursement, since Jose and I don't work for the OAS.
Dale, how is profit from an LLC taxed when a G4 is a passive member, not involved in running the company or the business?
Okay. So assuming you're a full-time employee of the OAS under a G4 visa, or a G4 dependent who is a non-resident of the US, and you're a member of an LLC with some other members, that means that you're actually, for tax purposes, part of a partnership. So a partnership tax return has to be filed, and you being a non-resident, you're considered a foreign partner. So make sure that whoever is the general partner of the LLC that's filing the partnership or tax return knows that you're a foreign partner, so that your Form K-1 that's issued to you that would report the income generated from the LLC is properly reported. Now, if you're a foreign partner, and you would be if you're a full-time employee or a G4 dependent, then there are some withholding requirements that the LLC has. They have to withhold 37% of any income that's generated within the LLC, and then they give you a credit for that income tax withheld because you're the foreign partner, and that's the reason they have to withhold the 37% on your portion of the LLC income. And then you would get a credit for that on your US 1040 non-resident tax return. So it gets pretty complicated.
And then the last question is, if somebody works at the OAS for many years as a G4 visa holder and recently received a green card, how will their pension be taxed? Will taxes apply only to the years after becoming a permanent resident? So I talked about how your pension income is partly taxable and partly non-taxable. That's always going to be the case. A part of it will be subject to taxes, a part will not. The ratio, the proportion of what is taxable and not taxable will vary depending on your status while you were working. Like I said, probably if you were a G4 visa holder your entire career, about 60% perhaps will be taxable. The more years you spend as a green card holder or US citizen, the more that taxable proportion will increase.
The next question is, can you have an online business like through Etsy, and what's the threshold for filing taxes? I assume you are a G4 dependent asking this question because I'm not sure that you'd be allowed to have an online business if you were a primary G4 working as an employee of the OAS. So, assuming that you're a G4 dependent, yes, and you have work authorization, as long as you have work authorization, you can have an online business, and there is no threshold for reporting or filing taxes with regard to your gross income from Etsy. If you have $1 of gross income from this online business, then you'd have to report it on the 1040 non-resident tax return, as well as probably a state tax return, whatever state you're resident in.
Mhm.
And with that, we'll turn it back to the OAS. Thank you.
Thank you, everybody.
Oops. Well, thank you so much, Dale and Jose, for the very interesting and enlightening presentation, and for answering all of those very specific questions. I'm sure that was very helpful. Just would like to thank everyone again for their participation, and just remind everyone that this session has been recorded, and the session itself, along with the presentation, will be available on the Staff Association website. And of course, you can always direct additional questions related to your retirement and pension fund with the fund office itself with Jeanette and her team. But do please remember that individual tax questions to those should always be addressed with a tax professional. With that, we'll close today's session. And thank everyone once again. Have a wonderful day, and please stay safe out there. Thank you.
Thanks very much.
Thank you, everyone.
Thank you, everyone.
Thank you.